What's happening in the world of finance today? Let's cover the whole spectrum. You came here for the truth, so let me unveil that for you. Take a look at the chart on the right hand side. You can see that the rally has been fueled by short covering. That's right. This is the year-to-date flows for US equities. You'll see either the short interest ETFs and the short interest single stocks have been gaining momentum. You can see as investors have been covering their shorts, the flows have been pushing these higher. So I will be going all over the map today. Just stay with me as I cover this information. Earnings growth goes global. And you'll see that during the financial crisis, of course, this had gone down. But ever since, the US has taken off like a rocket ship, whether you look at the prices or the earnings, apparently. What's interesting is that the world, excluding the US, hasn't seen the same gains. Now, while they want to highlight 2017, obviously it has risen. However, this is still at the level that it was at in 2011. So as I've covered here, the prices show you the exact same thing. You can see that while certain stocks in the US have increased, you'll note it hasn't been all around the world. That's something very important that we need to pay attention to. JP Morgan Switzerland is in a breach of money laundering standards. Can you believe it? Are you surprised? JP Morgan is guilty of something? Wow. Next. All right, so we have these CPI numbers. We know that inflation rates aren't what they say they are. So Shadowstats, you can check this website out if you've never heard of it, but I'm sure most of you have. These are the inflation, unemployment, and all sorts of different indicators. He recalculates everything to the levels that it should be, and he is able to come up with some very different numbers than what we are told. And according to John Williams, the CPI is actually supposed to be 9.8%. And the official rate, CPIW, is at 2.05%. Or the CPIU, let's say just say 2%, for example. Even if we were to be more conservative than John Williams and go somewhere in between the two, we know that it is significantly higher than what they are telling us. All right. We're looking at individuals who are literally still in debt from the previous Christmas from the spending they had done. Very interesting. Holiday-induced debt is a growing problem, although survey respondents say they plan to spend roughly the same amount that they spent last year. 24% of shoppers say they overspent in 2016, while 27% admit not making a budget at all. What they're saying, essentially, they put themselves in a rather large predicament by spending way too much last year, and they are still paying off that debt. That is extremely terrible. While people get themselves into debt buying things they don't need, unfortunately, it just compounds. Now, this one particular portfolio manager, he is basically just a microcosm of others. Millennials are entering the workforces, but their wages are going to be under pressure their whole career. They won't make enough money to pay down their debt, fund their life, and fund retirement when there's no pension. So they're going to need equities. That's right. Let's all put our money into equities because, according to him, well, there's at least a decade left. From the point today onward, a decade of gains. Well, I can only imagine the level of inflation that we will see if that's true. Apparently, according to him, the current bull market is only 4.5 years old, and apparently they last 15-20 years. The risk is not being in this market. Not in the market. This is the type of foolishness I read every day. I talk to people every day who think this. Owning a home may help you save money, but it won't help you make money. That's right. Households are better off taking control of their finances than relying on fluctuating home values. On average, renting and reinvesting wins in terms of wealth creation because regardless of property appreciation is highly correlated with gains in the traditional financial asset class of stocks and bonds. Basically what he said was that you should be renting your home and then invest in stocks. Wow. Now, you don't have to buy a home. You could rent. There's nothing wrong with that. But to think that your home is an investment, that's where you've got this wrong. Because people pull the equity out of their home and use it in that way. And that's totally wrong. If you want a home, pay it off. Pay off the debt that you owe. Then you can invest after that. Or maybe you want to take a little piece of your paycheck, 5%, and invest that. But pay down what you owe. A lot of people don't like to hear that, but that's the safe road. The $1 trillion fund that Norway has amassed pumping oil and gas over the past 2 decades wants out of petroleum stocks. So our perspective here is to spread the risk for the state wealth. We can do that by not adding oil price risk. Do they see something is going to change? I don't know. Let's check out those prices as time goes on. I just found it interesting here because they're a nation that is, obviously dealing with a lot of oil and gas, but seems interesting. Maybe they're just cashing in on some profits. Maybe they're moving some things around. It's interesting to say the least. John Hussman here. He said some interesting things here. That U.S. equity market valuations are at the most offensive levels in history. I like the word he chose there. Now, stocks are at a risk of a drop that could reach 63% and send the market spiraling into a full decade of negative returns. Stocks are more expensive than they were in 1929 and the year 2000. All of this we haven't seen yet. We don't know what's going to happen. But let me just say, if the stock market dropped 50% from its current levels, it would not surprise me. The reason I say this is because look at the financial crisis. It dropped 50%. And it did so because certain things were exposed about this market, about how fraudulent it is. And then they decided that we're not going to fix anything. We'll just print money and let's keep it going. And that brings me to my next article. Have we learned our lesson? It depends on what the lesson was. Einhorn, he's the co-founder of this particular financial company, and he said this: the so-called structured credit market risk was transferred, but not really being transferred and not properly valued. If you took all of the obvious problems of the financial crisis, we kind of solved none of them. We went the bailout route. I have been saying this over and over and over again. Of course, I get criticized. Maybe Einhorn gets criticized too. However, I'm not going to change my stance. Nothing was resolved, and it has to come back around to bite everybody in the backside. And then this. I find it hard to believe, but apparently Zimbabwe has a 95% unemployment rate. I knew it was bad, but 95% seems quite extreme. Either way, they don't have their own currency. They're in a situation right now, political tensions. You've probably seen it in the news. It doesn't look good for this at all. Look at what happened in 2008. That could happen to any nation. It's happening to Venezuela right now. A complete destruction of the currency to the point they have to use the US dollar. That's how bad things have become. Well, that's all for this video. It was a mishmash of everything put together, and I hope you enjoyed it and found it informative. If you did, please give me a thumbs up. When you do so, it pushes these videos higher up into the YouTube search rankings, so I do appreciate that very much. It is 3 o'clock in the morning. Way overdue for some sleep. I will post this right now. That's all for this video. If you found the video informative, I know you'll find my books, The Money GPS, and my newer release, Global Economic Collapse, even more informative. Check the links out in the description below. Take care and good night.